morning at 6:30, so some people might have decided that 2 hours of tax in the morning was too much for them, but hopefully it wasn't too much for you, right, CJ? All right, and Doug, you did it today too, right? Okay, so anyway, let's bring ourselves up to date on where we are and what we're doing. In terms of the material, let's see where today is a benchmark of sorts, because today, in my opinion, we get through some of the remaining complexity of subchapter J, and then for the next several classes, I think you'll see the material is progressively easier. So we'll see if you agree with me on that front. So reviewing what we covered to date, guys, we have chapter 1, just dealing generally with what is trust and what's in the state. Chapter 2, dealing with the entity as a taxpayer and talking about just general principles of how subchapter J operates. We have subchapter J with what is gross income, what's deductions, just general rules akin to those that we already know, applicable to taxpayers in general. Chapter 3, as I promised you, always was going to cover the most challenging aspects of subchapter J. And as we know, Code Section 643 defines what is D&I, and we know generally it's the taxable income of the enterprise, but does not include capital gains. Also includes tax-exempt income, but ultimately, we also, as you recall from Schedule B of the 1041, not only do we need to know what is D&I, we need to know what is modified D&I, right? Because only modified D&I is what's going to be deductible ultimately on the front page of the 1041. We talked about distributions to beneficiaries and what they look like, what those sort of distributions look like, direct and indirect distributions to beneficiaries. We talked about simple versus complex trust. Simple trusts are those trusts that only pay out income, they do not pay out principal. And then we spoke about complex trusts, those trusts that pay out not only income, but pay out principal and any charitable request. We looked at the fact that Code Section 651 talks about what's deductible with respect to simple trust. We talked about Code Section 652 talking about inclusion issues. We talked about complex trust insofar as Code Section 661 is concerned with respect to deductions, and 662 dealing with issues of inclusion. We made an observation that all estates are considered complex trust under Code Sections 661, 662. What I would like to do in terms of an agenda today, or tonight, is to just revisit what we looked at towards the end of last class. What is an estate, or how is an estate taxable? Revisit, because the final exam is cumulative. It will tax more heavily information that we cover in the second half of the course. But having said that, I'd like to just revisit and again, just go through one more time, because I'm sure there'll be a few problems on this dealing with Code Section 663, dealing with exclusion of particular distributions. So revisit that. We're looking at trapping distributions. Now that we've gone through most of the life cycle of a trust or an estate, from its formation to operation. What happens on termination? What are the salient provisions that you guys have to consider with respect to the termination of this enterprise? And the last segment deals with recognition of gains and losses when distributions are made from a trust or an estate to a beneficiary. So that's the last segment of chapter 3. Time permitting, guys, I'd like to talk to you about the beginning of chapter 4. Chapter 4 is a rather lengthy chapter, if you can see. But chapter 4 is the kind of thing that there's a lot of case law on chapter 4. There's not that many problems, because you'll see in practice the most important part of chapter 4 is being able to identify what is a grantor trust, not making computations. And just to give you a heads up, can anyone tell me, when you think of the word grantor trust, is there some sort of equivalent in terms of the grantor trust? How is it treated for tax purposes? Let me just start with a general question. How is a grantor trust treated for tax purposes? Go ahead, Dale.
It's disregarded.
Disregarded. And just to call your attention, so it's a disregarded entity. And you may have heard of disregarded entities in other spheres of taxation. The most popular disregarded entity, Dale, since you're on a roll,
The single member LLC.
a so-called single member limited liability company that is essentially ignored for tax purposes. So grantor trusts are generally ignored for tax purposes. Most of the time, making the income or deductions taxable to the grantor. But we'll see, guys, in the weeks to come, under Code Section 678, there's something called a Mellencrot trust, if I pronounce that correctly all these years. I'm not sure if I do. It's called a Mellencrot trust. Use that one this weekend. Under Code Section 678, where it's taxable to the beneficiary, okay? So the grantor trust generally is taxable to a grantor, but sometimes, depending on the circumstances, because the beneficiary has so much control or power over the trust enterprise, the beneficiary is taxed. That's largely found in Code Section 678, just to give you an idea. All right? Speaking of tonight, we will try to get through, again, finishing up largely chapter 3, getting a little bit into chapter 4, and my objective is to, next class, spend a fair amount of time going through your midterm exams, I'll call it the essay portion, and then going another 30, 35 pages into the grantor trust rules. So just a little heads up that we will probably spend 2 or 3 classes talking about chapter 4, and then I'll have some distributions to hand out, because in the remaining classes, what I wanted, 2 topics that I want to really focus on. Charitable trusts, which are not in your book, okay? So I'm going to give you a handout on charitable trust. And the second item that's not covered in any income tax course, but has a lot of relevance, and it's covered in this book, but not covered too well, and I'd rather give a handout or 2, is IRD, under income with respect to decedent. Okay? Many of you are familiar with the term IRD, the most common of which, guys, common example of IRD is? IRAs or 401ks, right? Someone dies and a distribution is made from that plan to a beneficiary. Right, Sal? That's IRD. That's found under Code Section 691. Code Section 691. So just to give you a heads up, for those who want to read ahead, don't read ahead in our textbook. Like I gave you a fair warning that I believe the book is pretty good, not perfect through the first 4 chapters, but I think we can do better with both respect to charitable trusts an IRD. So in the weeks to come, I will give you a handout on that. My other point is, things fall into place tonight. We will see if we can end class 3 to 4 minutes early. Why? You answer that question. We've got to get behind the wheels of our car to hear the debate, right? Everyone ready to hear the presidential debate? So who am I to keep you away from hearing the opening salvos with respect to the presidential debate? All right? Other questions, issues, concerns? Okay. So having said that, let's revisit some of the things that we looked at towards the end of last class and go from there. So let me just pick up on page 188, okay? Page 188, and just make some observation about some of these cases. So if you recall, again, your notes may already reflect this, but it doesn't hurt to emphasize this. Estates generally are all under the complex trust rules, 661, 662. And if you recall, if you keep your code open to the 661, 662, there's tier 1 and tier 2. 661A2 talks about other amounts properly paid or credited are required to be distributed. And in the Bohan decision, the question is, if the estate makes a distribution, recall that in most cases that until an estate is closed, it always has the right to get back whatever it paid out. So in this case, both the lower court and the appeals court blew it. How do I know they blew it? Because they claim that the estate remained taxable, notwithstanding that distributions were made. And they claim that it's because the monies could always have been recaptured by the estate that it was not properly paid. All right? So they took the position that in this particular case, the estate remained taxable rather than the beneficiary. Keep in mind, after 1986, most people would not want this outcome. Most people would want, again, remember, the whole world has been turned upside down since 1986 because Code Section 1E essentially has a flat rate. But here, given the tax years involved, it was advantageous to keep the estate open, right? Keep the estate open, lower bracket taxpayer, and therefore it caused an overall reduction of tax. Having said that, this is not a case that's followed, okay? If an estate makes a distribution under normal rules, and Anthony, we just got it started at page 188, all right? So just for your notes, make sure you have it down that this case is incorrectly decided. And the proper result is, as you're not surprised, that normally distributions pull out D&I, period. The larger the distribution, the more the D&I, and it pulls out in proportion to, or the characters in proportion to whatever the D&I is. Okay? But the important takeaway here is this case is wrong. I want evidence of that on page 190. There's a Buckmaster case spelled out on the illustrated material item 3 that comes to the exact opposite conclusion and correct conclusion. On the bottom, page 190, it points out estates generally have no first-tier beneficiaries. I've never seen an estate with a first-tier beneficiary, so I echo that. Yes, are not required to distribute income, quote-unquote, currently. And the authors elaborate in the material that follows that these are all tier 2 distributions. What happens sometimes an estate is payable to a trust. Picture, if you will, you have an estate that says, pay the entire residuary in trust for the benefit of my 3 children, and the trust pays out income to all 3 children, right? So again, picture if you have an estate with $900,000 and the beneficiaries of the estate is a trust for the benefit of 3 children, and it pays, the trust is supposed to pay out income directly to the 3 children. Suppose the estate just makes the income payment directly to the children. It never gets washed through the trust. Can the estate get a distribution deduction? That's spelled out on page 192. Okay, where it points out in a private letter ruling, 85-06-005, that the estate should be able to get a distribution deduction, which is then given to the trust. Okay, the trust should pick up the income, and then the trust can get a corresponding distribution deduction for the benefits payable to the estate, to the trust beneficiaries. Right, the point I'm making is, guys, what the authors are trying to make, is that sometimes people take shortcuts, right? Everyone get the visual that estates don't necessarily make the distributions they're supposed to. They pay it into a trust, or they don't pay it into the trust, but ultimately the right people get the income. So it's a matter of just, in my opinion, dotting the I's and crossing the T's, that technically it should be payable to the trust first, have the trust reflect the income, but then have a corresponding deduction to the beneficiaries of the trust. If you look at item 7 on page 192, timing can be critical. So picture you have a husband and wife's will. The husband dies first, and he leaves assets to his wife. We all know in this room, right, Code Section 1014 applies, right? Basis equal to fair market value, erasing any gains. Suppose that the estate takes 2 years to close, and in that 2-year period, the value of the stock goes from 100 to 150, and then the wife dies. Okay? Does the basis of the stock go up? Remember, the estate did not make the distribution. Okay, everyone got that? The estate did not make the distribution. The estate sells the shares before it makes the distribution. Who should pick up that $50,000 of gain? And if you look at the bottom of page 192, top of 193, there's 2 different cases and they come up with different results. And what ends up happening in one case, the estate remains liable on the tax. The other case, the court decided that technically the wife who subsequently died, and I think one of these, the husband was the surviving spouse, but it doesn't matter if you understand what I'm saying. The surviving spouse never gets the appreciated asset and dies. How would you rule in that case? Should it be considered subject to the rules of Code Section 1014? And you can see the opposite. Each one comes. And here's my 2 cents in this. If I'm an executor of an estate, and I have to get assets out to a surviving spouse, and the surviving spouse doesn't look too healthy, is it a good idea to get those assets out ASAP under current law? And the answer is yes, right? Because even if that person dies, I can tell you one thing for sure. If on a Form 706, if the person's surviving spouse dies, is that going to be includable in their taxable estate? for purposes of the estate tax? Absolutely. So if it's going to be includable in their taxable estate, you might as well as let them avail themselves of Code Section 1014 and make sure that they get the higher tax basis as a result of washing it through their estate. You guys tell me. You get that? In other words, you're an executor of an estate, and you have assets which are appreciating in your hands. You have beneficiaries who are elderly. It behooves you to get those assets out of the estate as soon as possible, right? Because if you don't, you risk an outcome where the person dies and the IRS takes a hardball position and say, look, Code Section 1014 doesn't apply. They did not have title to those assets. Right? We looked at Estate of Johnson towards the end of class. Stands for a simple proposition. Book entries don't suffice, right? If you make a book entry that simply says that the estate considers this distribution as being made, but the distribution isn't made, does that constitute properly paid or credited? And the answer is no, right? It is not properly paid or credited. Here there was just some simple book entries made. This is spelled out at the bottom of page 193. And the taxpayer took the position that that constituted enough to consider distributions, a tier 2 distribution. The court says, I don't think so. Why? Because for all intents and purposes, creditors could still get to the assets. All right, Code Section 663. Any questions on estates? So the takeaway, guys, is estates are taxed in no different fashion than the rules that we looked at with respect to complex trusts. Okay. Reminding you, with respect to Code Section 663, you should take a look at the regulations and the examples they are under. They're illustrative. Let me just remind you, under 663A1 says, and remember, if it falls within the scope of Code Section 663A1, right, the distribution does not carry out any T&I, right? The recipient gets this and does not have to pay income tax, right? Why? For all intents and purposes, this is an analog to Code Section 102A, right? So 663A1 says, any amount under the terms of the governing instrument is properly paid or credited as a gift or bequest of a specific sum of money or specific property, and which is paid or credited all at once or not in more than 3 installments. So it can't be paid in more than 3 installments. For this purpose, an amount which is paid or credited only from the income of the estate or trust cannot be considered a gift or bequest of a specific sum of money. Right, and the authors, when I say the authors, if you look at the regulations, there's several different examples that I invite you to go through, because again, on the final exam, I could just lift these examples wholesale, change a few numbers, and just make sure you've read the examples, right? So everyone can, these are very straightforward, but if, maybe in my world they're straightforward, but if you see it differently, and you don't understand how the Treasury regulations drew the conclusion, then go through it and raise it with them. There's some revenue rulings the authors call your attention to. The first revenue ruling deals with a specific request of a specific dollar amount. Normally, we would have no issue if it's a specific request of X dollars, right? It qualifies under Code Section 663A as a specific request. The only twist here is if you look at the second paragraph on page 196, it says the will of the decedent provides that from the residuary of the estate, the residue. So that seems to present a little bit of a problem, but in this particular instance, notwithstanding, it still constitutes a specific request, and as such, it does not pull out any D&I. Revenue ruling 68-49 points out that a non-probate distribution, non-probate. What does non-probate mean? Again, assets that do not go vis-a-vis the will, right? Non-probate. Typical examples are life insurance, retirement accounts, and jointly held property, right? 3 different examples of non-probate. Non-probate assets do not pull out, right? Do not pull out D&I. Why? Because again, they were not considered part of the estate. So if you own property, say with your parents, a father or son, picture your father and you're the son or daughter of your father, you own property jointly, sadly your father dies, you now inherit that property, that joint bank account. It's not going to pull out D&I from the estate. Everyone agrees? Okay. I'm going to call something to your attention, and just like, and we're going to see some examples towards the end of class regarding this, but this is one of the things that you can, and I say this because I want everyone to perform well in the final exam, so heads up, make sure you're paying close attention to this, because this is the kind of thing that many practitioners miss, not you guys. On page 198, the last full paragraph before the mod case, calls your attention to Code Section 643E. So if you can open up Code Section 643E, it's important. And add this to your must-know list for the final exam. Treatment of property distributed in kind. Everyone have that? 643E. The basis of any property received by a beneficiary in a distribution from an estate or trust shall be the just basis of such property in the hands of the trust or estate immediately before the distribution, adjusted by any gain or loss recognized to the trust or estate on the distribution. So normally, what does this signify? Then when you get a distribution from a trust or estate, what's your basis in that property? Not a trick question. Adrian? Carryover, right? It's carryover from the trust or estate, right? And this should remind you of partnership tax, right? That's section 731, 732, 733, right? Distributions from a partnership. You get a carryover basis. Agreed? Not always. There's some tricks to that, but generally you do. In contrast, what is your basis generally from a corporation that makes a distribution? Corporation makes a distribution, what's your basis in that property?
Fair market value.
Fair market value. I believe it's code section 301D. Let me just make sure I'm not misleading you on that. Yes. Feel good about that. Okay, 301D. All right. Why is that? Because corporations on distributions under code section 311 have to recognize gain on distributions, and on liquidations under code section 331, or 331, the shareholders who have to recognize it. In other words, corporation is truly treated as a separate entity, right? And distribution during operations, 311, or liquidations. And you're not responsible for this class. It's just making an observation about partnerships. Generally, non-taxable distributions are made, right? Everyone agrees. In contrast, corporations generally taxable. With corporations, you get a basis equal to fair market value. With partnerships, you get a carryover basis. Here, notice with trust and estates, we've seen it sort of has a leg in both worlds. And here's an illustration where there's a carryover basis. Agreed? All right. So that's one point. That's a takeaway. You got to know that, right? That the recipient gets a carryover basis. Critical. Another critical. So don't lose me on this because this is just as critical. Look at code section 643E2. In the case of any distribution of property, the amount taken into account under, right, the complex rules, right, because they're not talking about income distributions, they're talking about principal distributions, agreed? Right, we're dealing with tier 1 and tier 2 distributions, right, guys? Shall be the lesser of, so this is the amount going to be considered distributed. The basis of such property in the hands of the beneficiaries, or the fair market value of such property. So what this means, right, Adrian, is that when we make distributions from a trust or an estate, the amount that we, for purposes of computing the distribution deduction, is not necessarily the fair market value of the property. Typically, right, in the key case of most appreciated property, where the basis is lower than the fair market value, that the distribution deduction will be limited to fair market value. In other words, when you distribute out, say, property with a $10,000 basis, fair market value of $100,000, the D&I that will be pulled out of that will be $10,000, not $100,000. Even though you might say, gee, the distribution is $100,000, right? Everyone got that? Because a lot of students I know in the past would get flummoxed by that. Patrick, have you got that? So, and we're going to see several examples towards the end of the class regarding this.
What's the reason for that?
It's a question of liquidity. Is that down the road, is that the beneficiary, there's no leakage to the system because the beneficiary has a $10,000 basis in that property, and when he or she sells it, they will pick up the $90,000 gain. If you tax them, say 25% on that, $100,000, they owe tax, $25,000 on property that is, for the moment, let's assume it's illiquid. All right?
You're saying the trust. If you
I'm
tax.
saying the beneficiary because it's
Oh,
pulling out the
pick up.
D&I.
Got it. Okay, got it.
All right, everyone got that? So this is critical, and I'm not saying this in a way that I hope you perceive as threatening, but you see it on the final exam where I could ask several questions in several different ways pertaining to Code Section 643E1 and 2, because this will come up in practice, and I can tell you a healthy minority of people do not get this, okay? But this should not, that fate should not befall you. sir?
It's section 643 E1B.
643, E1B.
Yeah.
Okay. Good question. You're saying, when will there ever be gain or loss?
Yeah.
Look at 623, E3. Okay? You can make an election to recognize the gain. Okay, so there is an opportunity where normally that most people would not make an election. One of the last questions we'll look at is, when would you consider, if you're the trustee or an estate executor, to make the election to recognize the gain?
Oh, that's for the trust or estate to make a.
Right, when would the trust or estate ever elect to recognize a gain?
If they have losses to use up.
If they have losses to absorb, or maybe you want to recognize a small gain. Why? If you can. Because notwithstanding my blanket statement that trust and estates are taxed at a flat rate, truth be told, you know, under Code Section 1E, at least some small amounts of income do have a lower bracket, right? Everyone agree? So you could, if you had expiring losses, or if you had a situation where if you use some of the lower bracket, you might decide to use that, right? Right? All right. So just we're going to go through. If you're feeling a little lost, I hope you're not feeling lost at all, Tina. But I can tell you, we're going to go through several examples towards the end of class that hopefully will solidify your knowledge with Code Section 643. All right. So fear not. We will go through. Again, the authors mention it in a passing paragraph, but it's important really to make sure you have down. All right. Then we have this Mott case. Okay. Okay. What are the facts in Mott? I say tongue-in-cheek. This is a small estate. Given the years involved, it's 1962 with $36 million, right? You can figure out what this would be worth in present value terms in 2016. And under the terms of the will, we have 2/3 of the estate that goes to this charitable foundation, Teagle Charitable Foundation, however you pronounce it, Teagle, I'm not sure. And the residuary of the estate was payable to an individual, right? Jane. And all the income was to be payable to a trust for the benefit of the spouse. So 2/3 to charity, 1/3 in trust for the benefit of this Jane. And during the years in question, large sums were made payable to the foundation, and there was a $100,000 distribution made to Jane. 1963. So, the question is whether the trust is entitled to deduction with respect to distributions made to the foundation. And the first thing the court does away with, the taxpayer might argue, is that whether the gift to the foundation is a gift of a specific sum of money. And if it were a gift of a specific sum of money, we know that Code Section 663 applies, and therefore it would not pull out D&I. So let me repeat that. The court has to at least look at whether or not Code Section 663 applies here, and whether or not this was a specific sum to the foundation. And the court says no. Okay. Why? This is not a specific sum. Since this was expressed as a percentage of the estate after the payment of administration expenses and other charges, that you could not, it was impossible. You can only qualify under Code Section 663 if you know at the moment the person dies what that dollar figure will be. If someone says I leave $100,000 to a particular charity or particular person, right, that's going to be Code Section 663, right? If you know at the moment the person dies what the recipient's going to get, Code Section 663 applies. In contrast, if someone leaves a proportion of the residuary estate to a beneficiary, you cannot specify with any specificity what will go to that beneficiary. Why? Because you do not know at the moment the person dies what the administrative cost will be to handle the estate. You cannot say, hey, if you're getting 1/3 of an estate or 2/3 of an estate, exactly what is that dollar figure that person is going to receive or that entity. So Code Section 663 does not apply. Everyone agree? Residuary beneficiaries will never ever, did I say never ever? Never ever qualify under Code Section 663 as a specific bequest.
Wait, what about that 57-214 revenue ruling?
Which one?
The revenue ruling from Ford. Did you say that was
Dude,
permanent?
remember, that one was...
Because it was X amount of dollars.
Yeah, it was X amount of dollars. So Dill's asking, what about revenue ruling 57-214? It was payable, it wasn't a percentage of the residuary bequest, it was a specific dollar.
So it has to be a dollar amount.
It has to be a dollar amount. It cannot be a percentage. Percentages in percentages in Code Section 663 are antithetical to one another.
Okay.
Not going to work. Now, here the estate was not entitled to a Code Section 642C deduction. Why was it not entitled to a 642C deduction? Because all the income was payable to Jane, and the payments to the charity were to be made out of principal. So under 642H, did I say that right? Under 642C, excuse me, to qualify for the charitable deduction, the payment must be made out of income. Here it was impossible for the payment to be made out of income. The payment to the charity was going to be made out of principal. All right, so let me just rehash this. This is not going to fall within the scope of Code Section 663, this distribution to the charity. It's not going to fall within the scope of 642C because it doesn't qualify for the charitable deduction. So is this distribution going to be a Tier 1 or Tier 2 distribution? Take a look at Regulation 663A-2. 663A-2. Everyone have it? Regulation 663A-2. Any amount paid permanently set aside are to be used for the charitable, etc. purposes specified in 642C, and which is allowable as a deduction under that section, is not allowed as a deduction to an estate or trust under 661 or treated as an amount distributable for purposes of determining the amount includable in gross income of beneficiaries under 662. Okay, let's go through this all. Any amounts paid for charitable purposes specified in 642C and which is allowable as a deduction under that section is not allowed as a deduction to an estate or trust under 661 or treated as amount distributed for purposes of determining the amounts includable in gross income of the beneficiaries at 662. In other words, and where we're looking at, by the way, let me just call your attention to this. Look on page 202 of the case. If you look at the first full paragraph on page 202, the taxpayer is saying, look, I'm paraphrasing, the taxpayer is saying, look, this amount was paid out to the charity, and as such, it should qualify as a Tier 2 distribution, okay? Tier 2 distribution, and reduce the amount of D&I. Now, from the taxpayer's perspective, meaning the trust perspective, by getting this deduction, that's a good thing because it gets a deduction, and guess what? Does the charity have to pick it up in income? And you guys know the answer to that, right? As a tax-exempt enterprise under 501c3, it's not going to have to pick it up. So there's leakage here. But the taxpayer said, look, it's an amount that is paid out. How can you argue against that from happening? If you keep reading, it says the government contends that quote-unquote amounts cannot be read literally and that section 661A2 does not apply to these charitable distributions. Okay, so the government says, yeah, if you read the statute literally, the taxpayer is right that it should be entitled, but you can't read it literally. And it relies on the regulation that we were just looking at. From the reading the regulation, two things seem clear. First, it is dispositive of the issue in this case, since it prevents an estate from claiming a deduction under 661 any amounts distributed to a charity except as permitted by 642C. In other words, if you don't qualify under 642C, which this did not, right? It was not payable out of income. It was payable out of principal. Essentially says, the regulation says you can't deduct it. You cannot get a deduction. Yeah. And bear in mind, and you guys may recall this from your days of income tax, over the last 100 years, the Supreme Court in the area of tax and also virtually all the other areas of administrative law, what is the Supreme Court's position when it comes to agency regulations? What is the position? If you remember the court case Mayo Foundation,
They defer.
they defer, and that extends well beyond tax, right? It goes anywhere where an agency like the EPA promulgates regulations. As long as the regulation is not arbitrary and capricious, guess what? Courts are supposed to respect it. So here, this court said, look, we're only going to, that regulation, by the way, this regulation that we're looking at, you really can't read the statute. It doesn't, the literal language of the statute doesn't really say what the regulation says. So it's an extension, you know, it's a push. But this court says it's a reasonable push. Why? Because essentially what the regulation is saying is that, look, Congress did not want someone to get a deduction, an estate or trust to get a deduction, unless it fell within the scope of 642H. Why? 642C. Why? Because if you recall, Code Section 661 and 662, aren't they supposed to be read as peanut butter and jelly? And what I mean by that is that 661 says you get a deduction, and essentially says, what is the price tag for getting a deduction? That the beneficiary has to include it, right? An income. And in this particular circumstance, the taxpayer is being pretty avant-garde and saying, well, we qualify under Code Section 661, right, for deduction, but here's the reality. There is no inclusion under 662, right? There is no inclusion under 662. So, if you look on page 203, the second full paragraph, on page 203, the second sentence says, therefore the government asks us to interpret 661A as permitting a deduction only for distributions to taxable beneficiaries, based on its argument that 661 must be read interdependent with Code Section 662. On the top of page 204, it says, as we read 661 and 662, Congress intended to do nothing more than combine the conduit principle with a conclusive presumption that distributions subject to the operation of those sections are distributions of income. Such a presumption is, we think, inapplicable to charitable deductions. Then it adds, and this is what I have highlighted in red, as 642C provides, a charitable deduction is available only if the source of the distribution is gross income. Tracing of charitable deductions is still required under 642C. Remember, the tracing rules are the old rules. And after 1954, there's supposed to be no tracing, right? You don't get to label something as income and principal. D&I is supposed to erase the tracing rules. But there is one caveat. 642C still requires a tracing rule. And to the extent that the charitable deduction is not paid out of gross income in accordance with the requirements of 642C, then we think Congress intended that no deduction is allowable. Then in the next paragraph, it explains the abuse that could go on strategically if the taxpayer were allowed to prevail. So the takeaway here in this particular case is that if you don't qualify under 642C, that distributions to a charity will not qualify as a Tier 2 distribution. Okay? If it doesn't qualify as a Tier 2, there will be no deduction allowed to a charitable beneficiary. Any questions? That's the takeaway there. Does this come up a lot in practice? I can't tell you it does. What are the important things for the moment to take away? Estates are treated as complex trusts. Take away or make sure you guys understand what are particular distributions under Code Section 663. And third, and again, we're going to revisit this, is make sure you understand Code Section 643, E1, E2, and E3, right? Because those lend themselves to multiple choice questions or I'll call them essay questions. Trapping distributions. You ready? Talk about trapping distributions. What in yesteryear did people want to do?
One of the income at the trust level.
They wanted to trap income at the trust level, and they wanted income trapped at the estate level, right? So trapping was, some people like to go hunting or fishing. Us tax practitioners like to trap income in favorable positions, right? Everyone get the visual? It was a sport of sorts. In one way, you might trap income. In the case of an estate, it was pretty straightforward. What would you do to trap income in an estate? What was the modus operandi of many practitioners?
Delay the closing.
Say again, Dale?
Delay the closing.
Delay closing, right? Keep that estate open as long as possible, right? With a trust, what would you look to do?
Defer as long as possible.
Say again?
Keep it open as long as possible.
Not necessarily. I mean, it can't hurt to keep it open, but another thing was to get, if possible, large distributions. Keep in mind, and this is critical, and a lot of people get lost on this, so let me help you on this. Think about this. Many people, and I've had several cases where this has come up. Some of your clients have beneficiaries. The beneficiary designation form controls for a retirement account, right? Picture, if you will, that you have a client with $1 million IRA. Okay, everyone have the visual? $1 million IRA. And the named beneficiary is a trust for that person's daughter. Okay? Trust for the person's daughter. And the person dies, and Fidelity, let's say, is the plan administrator, cuts a check, for the trust is the beneficiary, and the trust gets the $1 million. Right? Everyone got it? And the terms of the trust pay all income to daughter for her lifetime, right? That $1 million comes into the trust, and let's just say the income on that is 10% return or $100,000. Okay? So her father dies January 1st. The $1 million goes immediately into the trust. By the end of the year, there's 1.1 million, right? What is daughter entitled to? What's the taxable income of the trust? Tentative taxable income. Say again, Zach? What is it?
The 10% of the.
Yeah, it gets a $100,000 interest payment on the $1 million. So what's the taxable income of the trust?
100,000.
Well, what happens to the IRD under 691? The $1 million.
That brings it up.
Well, let's put it this way. If the trust made no distributions, Jenny, how much would the trust pay tax on? 1.1 million, right? Everyone agree? I mean, you got a distribution from an IRA of $1 million of IRD, income with respect to decedent. You got $100,000 of interest. It's going to pay tax on 1.1 million. Agreed? Here's where a lot of people get flummoxed and confused. Because the terms of the trust say pay all income to daughter, right? It's very simple. It's a simple trust. Agree? And there's a temptation, right? When people see, oh, the trust has 1 million of IRD and 100,000 of interest. If I'm the trustee, you might think to yourself, oh, I'll pay out 1.1 million. Would that be correct? And so you had said something softly. What was that? Well, you said no, but you alluded to something. What was that?
I was thinking about 10% of the interest.
But why is the $1 million not going to be distributed? You had mentioned something.
So
Okay, I mean, I'll put words in your mouth. Under the Principal and Income Act, right, that payment, even though it's income for tax purposes, that distribution into the trust constitutes principal under the Principal and Income Act. And what do we know about distributions? Are they dictated by the code? Are they dictated by the Principal and Income Act under the appendix of in our book? And the answer is the latter, right? Everyone agree? So when that trust gets 1.1 million, there's only going to be, the daughter can pound on the table, she's only going to get 100,000, agreed?
Because that's the fiduciary accounting income.
That's the fiduciary accounting income. And that million is going to be tracked. Now, that's not going to be good news in 2016 because that million is essentially going to be taxed at 39.6%,
So the
right?
trust also pay tax on that $1 million because it's the.
Right. Everyone get the visual? It's being tracked at the trust level. Yeah.
If the IRA is paid to the trust, it's not a tax-deferred situation there. The trust picks up all the income as a distribution.
Why should life not be more complicated? Under Code Section 401A9, there's something called the minimum distribution rules.
Yeah.
And under the regulations, depending on how the beneficiary designation form reads, you can do what's called a stretch IRA.
That's what I was.
And you can pay it over the actual lifespan of the trust beneficiary, but it really depends on how sophisticated the beneficiary designation form is.
Okay.
Right? But I'm making it simple here, Anthony.
It's already complicated.
No, but you raise a good question. But I'm not going to test you on the more complicated
Yeah.
aspect. But you're right. All right. All right. So that gives you a sense. Estates trapped by their longevity. But in today's, just to point out, the IRS will virtually never, I've never had an estate question for staying open too long. Just, the IRS knows there's no upside now keeping an estate. Trusts, likewise. Do people want to trap distributions? No. But you should be aware of it because sometimes it just happens, like I'm describing to you. And I've had many instances where this has happened, not because it was to the taxpayer's strategic advantage, just happenstance where the distribution got trapped. All right, so just call your attention. If you look on page 205, this second full paragraph on page 205 under trapping distributions, just after the first sentence says, the estate had D&I made distributions to a testamentary trust. The estate therefore it was entitled to a distribution deduction, and the trust was subject to taxation on the distributions, right? It's going to get a K1 reflecting the estate's D&I, though they can constitute principles in the hands under local law. So when a distribution is made from an estate to a trust, often under the Principal and Income Act, the trust will be deemed to have received principal.
Now, is that only if that distribution kind of establishes the trust, or as opposed to the trust having like an income share of the estate or something like that?
No trust has an income share of the
Okay,
estate.
I don't know.
I'm just letting you know.
Okay.
It will not.
Okay.
The trust was required to distribute income currently, but was neither required nor permitted to distribute principal. The court therefore held that the distributions were, quote unquote, not required to be distributed currently by the trust. Neither could they be quote-unquote properly paid out of the trust. Accordingly, the trust income beneficiaries were not subject to taxation on the distributions because the trust was not entitled to a distribution deduction. Distributions were quote-unquote trapped there. As a result, the trust paid the income tax on the portion of the estate's income. So that just gives you a general idea. All right, so look, let me just give you a quick overview of what happens in the Van Buren case, 1987 case. We have a surviving spouse as the beneficiary of a testamentary trust. Here we have a surviving spouse as the beneficiary of a testamentary trust. And the estate makes a distribution to the trust, and this is spelled out on page 206. And as a result of the estate, okay, picture if you will, here's the estate making a distribution into the trust. And we know that when the estate does that, that distribution is going to pull out D&I, right? Generally, again, if Code Section 663 doesn't apply, which assuming it doesn't, the distribution is going to pull out D&I. And here the D&I was comprised of two components, about $26,000 of dividends and $40,000 of other taxable income. If you look at the second to last sentence on page 206 of the first paragraph, so if you page 206, first paragraph, second to last sentence, says, although the estate principal distributions constituted income to the trust for tax purposes, it retained its character as principal in the hands of the trust for fiduciary accounting purposes. That's important. Okay. Again, the estate makes a distribution to the trust that pulls out D&I from the estate, makes it, the trust gets K1 with lots of taxable income. Everyone agree? But it's not considered income for fiduciary accounting purposes. Agreed? Under the Principal and Income Act, it's considered principal in the hands of the trust. Meanwhile, the trust itself, so it gets a lot of taxable income, right? Taxable income. But the trust itself has a lot of tax exempt income, okay? So wherever the assets of the trust are invested, it's generating a lot of tax exempt income. It had $7,000 or $7,600 worth of dividends, but $41,000 of tax exempt income. Okay, so everyone had the visual here. The trust has two different sources of income. One from the estate, which is all taxable, and another source internally generated, right? That's largely tax exempt. Now, when the trust computes its D&I, when the trust has to compute its D&I, what's the starting point for computing D&I, guys? Taxable income, right? When you're doing on page 1 of a Form 1041 in Schedule B, does it know if it's coming from internally generated or externally generated? And the answer is no, right? When you're computing the taxable income, this enterprise. Because you know where this is going. The taxpayer is going to receive a distribution from the trust. The taxpayer would like to say, oh, the income is largely tax exempt because that was what was internally generated. The IRS, okay, look at the top of page 207. This reflects the taxpayer's position on the top of page 207. It just looks at the internally generated trust income and gets a distribution and says, gee, 38,000 is tax exempt, and 6,700 is taxable based on internally generated. But if you look below on page 207, the IRS position is, oh, you can't just look at the internally generated, right? You have to look at the trapping distribution, which includes the dividends and other taxable income. And from there, we'll back into what's being required to be distributed. But notice, a much greater proportion of this income will be taxable to the beneficiary. And if you go on to page 208, the last full paragraph on page 208, it says, the income of the trust, both received from the estate as well as from the trust internally generated income, is then computed under 642 and 641 and 642. And both the above elements go into the computation of the trustee and I under Code Section 643. And the judge on page 209 says the taxpayer's position is reflective of pre-1954 law, so that's not going to cut it. And if you look on page 210, the second full paragraph, says, to summarize, we conclude that neither the trust instrument nor local law specifically allocates different classes of income to the petitioner. The petitioner's income from the trust thus consists of the same proportion of each class of income constituting the D&I of the trust as the total of each class of income bears to the total D&I. Just stating a general proposition. Right? So your takeaway for this purpose, guys, I mean, even if we didn't talk about this tonight about a trapping distribution, that whatever income goes into making D&I, whatever income from whatever source, you have to take that into account. Okay? Even if it's externally generated, which would often be the case. So it's not just the internally generated income, it can also be the external generated income, which the authors of this opinion point out, even though it's referred to as D&I, distributable net income, here, I sort of like the phraseology here, it's really undistributed D&I, okay? The monies that are coming from the estate are, even though they go into the D&I, they're not really being distributed. So the authors of this opinion refer to them as undistributed D&I, right? Trapping distributions might get the name undistributed D&I. Now, truth be told, I will not, on page 211, 212, 213, 214, there's a discussion of what's called a Holloway adjustment. Okay? You do not anticipate, this is getting a little esoteric for our purposes. On our exam, do not look for any, unlike Code Section 643, E1 and E2, E3, where I'm saying that you'll possibly see some questions. You're not going to see any question, I promise you, pertaining to a so-called Holloway adjustment. Okay, so you may have other concerns. This should not be on the top of your list. Having said that, just for a moment, I'll just call something to your attention. But again, for exam purposes, do not, you'll focus your energies on other things. Look on page 214. I'll just pull this to your attention. On 214, there's a pretty straightforward example. Again, not going to hold you responsible for this, but just watch this. Deed dies in year 1, leaving an entire estate to a trust that pays income to his son for life. Okay? It's a simple trust. Why is it simple? No principal distributions, right? Everyone agree? Remainder to S's descendants. You guys are getting good at this. How would we refer to this trust? Put a name to it, Lisa? The GST trust, right? It's going to skip the son's inclusion in the son's estate, right? And the only thing to stop this, at least in yesteryear, was the rule against perpetuities, right? The property had to vest within 21 years in the life of the. To simplify the example, assume both that the estate and trust are calendar year taxpayers. For year 1, the estate earns $20,000 in taxable interest, all of which is D&I and fiduciary accounting income, okay? So the estate is going to earn that. The executor distributes $150,000 a principal to the trustee on December 31st. This is a trapping distribution. The $20,000 in D&I is trapped in the trust because the entire distribution is treated as principal. Right? Everyone see that? That the estate's going to distribute $150,000 apparently, and then $20,000 in D&I is going to be embedded, right? That the trust will get a K1 showing $20,000 in D&I. Agreed? Let me pause there. Everyone see that? And it's trapped there, right? It can't be paid out. Agreed? And the author says, assume the trust pays taxes at a flat rate of 25%. On April 15th of year 2, the trustee pays $5,000, right? Where's that $5,000? That's 25% of $20,000. Everyone agree? And charges the payment to principal. Okay, pause there. Everyone see that? So the trustee has to write a check for $5,000 in year 2 relating to that trap distribution. And some of you have raised this before, right? Like some people are under misimpression. We already went through this. Does a simple trust, we say pay tax? And many of you, at least at the beginning of this course, said, no, simple trust doesn't. It pays out all of its income. And we learned that was not correct. What context did we learn that was incorrect? Capital gains, right? Everyone agree? But now we're seeing, gee, not only with respect to capital gains, but also with respect to trapping distributions, right? They can be trapped in a simple trust, can pay tax. Assume that by the end of year 2, the trust has collected through an investment which has collected $15,000 in fiduciary accounting income. $15,000 with fiduciary accounting income and D&I. Assume that either the trust instrument or local law permitted that such an adjustment. The second Holloway decision would require that the income account to reimburse the principal account for the $5,000 of taxes paid by the trustee in April. And it will explain why in the next paragraph. But to make the remainder person whole, okay, $5,000 is going to be paid to principal. As a result, the trustee only has $10,000 of fiduciary accounting income to distribute to S in year 2. So the distribution deduction is going to be limited to $10,000. And it says the $20,000 of fiduciary accounting income in the next paragraph, earning year 1, will eventually flow through to S, the income beneficiary of the trust. When S receives this distribution, it will likely be income tax free. To demonstrate this point, suppose that sometime in year 3, the estate distributes all the remaining assets to the trust. So now the estate is going to terminate, the trust is going to get all the assets, $20,000 of income from year 1 will be immediately distributable to the son due to the early characterization of the fiduciary accounting income will likely not be taxable to the son because the D&I associated with the $20,000 already triggered income taxes in a prior year. According to Holloway, the trust income account is therefore required to reimburse the trust principal account for the income taxes that were earlier paid on these earnings. Your takeaway, okay, guys, is that if there are these trapping distributions and taxes do have to be paid, and you're not going to be tested on this, okay, there is this provision in New York law, state law, and other state laws say that the principal beneficiary, in this case the grandchildren, have to be made whole. That, in other words, that income earned in subsequent years to pay those taxes, those are no longer amounts available to the current income beneficiary. Listen, let me stop why I'm behind because I'm not sure how much you guys are going to pick up on this. Just again, my goal for the first half of this class, we have what is an estate, distributions under Code Section 663, Code Section 643, E1 and E2, and just have some familiarity with the notion of trapping distribution, not this Holloway adjustment, but rather the notion that distributions of income for income tax purposes like IRD are not income under the Principal and Income Act. And that the fact we call it income, right, where, for example, we said we're going to pay income from a retirement account into a trust, it does not constitute income for purposes of the trust beneficiary. Okay, everyone have that? That's my takeaways from the first half of tonight. The second half of tonight is going to deal with trust terminations, trust and estate terminations. So let's talk about one or two cases, then we'll take a break and go from there. Okay? How long do estates last? Yeah, this Raska case, we have a person dying in 1974. Funding his residuary with a charitable trust. And here there's a whole bunch of dates which are somewhat important, okay? Where there was an estate tax return filed. So the person died in 1974. You know that you have 9 months to file an estate tax return. If the estate tax return was timely filed 9 months later, this is about a year later, the estate receives a closing letter. So I generally tell clients not to make distributions until they get, if there's a federal and New Jersey return, until they both get closing letters from both. In today's day and age, many more people only have New Jersey estate tax returns. So I tell people generally executors don't make distributions until New Jersey issues a closing letter. What is a closing letter? Essentially, New Jersey and or federal government saying, we've looked at the estate and we believe there's no taxes due and owing. Okay? About 4 or 5 months later, there's a final accounting filed. The account is approved a few days later. And what happens is a majority of the estates, there is stock the estate owned, and the shares are sold. Okay, so there's a lot of appreciation, notwithstanding Code Section 1014. Over the few years the shares were held, they apparently appreciated in value. And the question before the court is who owns the shares? Is it owned by the estate or is it owned by the trust that's established under the will? That's the key, and it's a factual question. These appreciated securities Are they owned by the estate? Are they owned by the trust? Why? Who cares? Why do you care? Why does it matter here? Why does it matter? It's really important here, actually, because
Determines the basis, right?
say again.
Determines the basis of, depending on who owns it. There was
No, this is not like there's no one subsequently dying. The earlier fact pattern, we had a surviving spouse, right, who was dying, and it was critical at that point to know who owned it. Here, it's because of Code Section 642C. 642C, if you recall, that set-asides no longer apply to trusts. That if you set aside income payable to a charity, it no longer can qualify after 1969. 642C no longer applies. It only applies to monies, income, set-asides for estates. So they're only going to get the charitable deduction if this money is deemed payable from the estate rather than the trust. So lots of money turns on that. Okay? Now, here, just so you know, on page 216, the second full paragraph, it said it listed the trust as the owner of the 17 blocks of securities that were sold, and that the trust was the appropriate taxpayer. So, and on the third paragraph on page 216, just to back this up, it says, an audit, IRS determined that the trust was liable for additional tax because 642C does not allow a trust established by the will executed after October 9, 1969 to deduct the income payments permanently set aside for charitable purpose. Conversely, in its petition, the taxpayer has abandoned the claim that it was entitled to 642C deduction. Instead, taxpayer claimed the trust is not liable for the additional tax because the estate, not the trust, was the seller of the securities in question. Claims the estate never distributed the securities to the trust. Rather, according to the taxpayer, the estate sold the securities and distributed the sale proceeds to the trust. Therefore, the question we must resolve is whether the securities were sold by the estate or the trust. Okay, so the big issue is who sold these securities? Was it the estate or the trust? Now, there's two ways in which the gain could be taxable to the trust. Two ways. If the estate is deemed to have terminated, okay, and the operative regulation is what the authors cite into, is 641B-3A. I'll repeat. If the estate is deemed terminated under 641B-3A, or if there is an actual distribution. So even if the estate hadn't terminated, but there was an actual distribution from the estate to the trust and the trust sold it, then it should be responsible. If you were to look, you don't have to look, I'll paraphrase it. Regulation 641B-3A says if the administration of an estate is unreasonably prolonged, the estate is considered terminated for federal income tax purposes after the expiration of a reasonable period for the performance by the executor of all duties of administration. Now, some of the dates here are hard to follow, but one thing I can tell you categorically about this estate is that it was essentially closed within 1 year of getting closing letters from the IRS. And I can tell you from experience, anyone who can close an estate within 1 year of getting closing letters from the federal government or state of New Jersey, that's 100% reasonable. No one's ever going to say that's unduly prolonged, okay? And if you said to me, what would be unduly prolonged? There's no hard and fast number, Certainly, if anything, I'm going to make up a number. Anything beyond 3, 4, 5 years would probably be, in the IRS opinion, unduly prolonged. But certainly 1 year, not going to be deemed unduly prolonged. So the IRS cannot win invoking this regulation. Okay? So for the record, guys, this is an example of an estate that was very timely and efficiently managed. It was not unduly prolonged. So the IRS is not going to win on that front. So the only way the IRS can win is if the stock certificates were deemed distributed to the trust, from the estate to the trust. So that's the only way that the IRS is going to win. But if you recall, who actually sold the shares, who endorsed the shares in the process of selling it? And it was all endorsed in the executors, in the name of the executor. Okay, factually, I'm just calling that to your attention. It was all these were done by the person, and I believe the executor and the trustee were the same person, okay? So just bear that in mind. But the reality is, everything was done in the name of the executor. So the only stupid thing, if you don't mind me saying so, but they only had the advantage of hindsight, because once they realized that, oops, we don't qualify for the charitable deduction, did they say, oh my God, what do we do here? The stupid thing they did is they reported the gain on the trust return. If they just reported on the estate return, it would have been fine. But they made a mistake here. They paid a dear price for that. But factually, the facts supported their conclusion. They just they thought they were going to get a deduction anyway. All right. So, look, is this the most important case in this textbook? Absolutely not. It just illustrates what is it here? What's your takeaway? It's just to illustrate this regulation, 641-3A. It's illustrating, if you don't mind me saying, an example of when something is not unreasonable, okay? So you're getting a taste of something that's reasonable from your reading of this. And in the material that follows, guys, and then we'll take a break, is that if you look on page 219, it says, courts have considered the following excuses sufficient to justify holding an estate open. If there's claims that remain unresolved, the claims against the estate remain unpaid, the estate's claim for a refund remain pending. The estate's claim for a refund remain pending. They go through a whole list of things that have justified keeping the estate open, right? In contrast, if you look at page 219, the second full paragraph, it talks about all those reasons that have not passed muster, right? Continuance of ancillary probate, continuance of partnership, owned interests, continuance of legal life estate, all this kind of hokey stuff. Not going to cut it. Do these cases come up in the year 2016? Categorically, absolutely not. All right? I mean, I would tell a client, I mean, your job, I think, and by the way, most clients, what interest do they have in closing the estate, aside from high taxes? They don't want to pay your fees to keep doing their 1041. Right, guys? And that's a real motivating factor. You can't tell them on one hand, gee, I want to fund my child's college education fund, got to keep this estate open. And plus, you know, at some point, they're really going to feel you're doing, aside from your fees, there's going to be a lot of, you know, major income tax burden, right? Because these are truly taxed at a high rate. So this is not going to be something that people keep open. On page 220, and then we'll take a break, talks about at the very bottom that when does a trust terminate? I create many trusts, and the verbiage says when the person dies, that the trust goes to, say, the grandchild, right? Or when the person turns age 40, and let's say their birthday's on December 31st, and when they turn age 40, the trust principal distribution should be made to them, right? When does the trust terminate? Does it terminate the day the person dies? Does it terminate when that person turns 40? And what's the practical answer? Adrian, you were going to say?
Turns 40.
Say again?
When he turns 40.
Well, life isn't so crisp and clean, right? So it may take until the next tax year, right? Several months before the trustee feels comfortable. Because, again, before, if I'm the trustee or if you're representing the trustee, what are you going to demand before you make a distribution? You're going to demand a release from the beneficiaries, right? You never ever want to make a distribution to the beneficiaries, right? And have them subsequently try to sue you. Because if they want to sue you, where do you want to get the money to help defend the lawsuit? The trust, right? Now, if you're derelict in your duties, you're going to have to, pay back the money. But you certainly have an upper hand, right? If you have the money. Once you release the money, all bets are off. So you want to release, and you want your clients to be released from liability. If the beneficiaries have a problem, you want to know it before you make the distribution. So the person turns 40, and you know that person's a problem, if you know my message. The day they turn 40 is not the day you cut the check to them. All right? Probably. You're going to ask her for a release. They're going to ponder it because they're not the nicest people in the world, and you'll see what happens. So the message is it may extend into the next tax year, but again, it's not going to be an issue the IRS raises.
So the true the true termination date is the date of the actual distribution.
The actual distribution, right? And then you'll file a final trust tax return.
Right.
All right? All right, and given the fact it's the final, all the capital gains and everything will be paid out, the final year there should be a taxable amount of 0, right? Everyone agree? Generally 0, because you're not going to hold back any money. I mean, often I will say to the trustees, let's keep a reserve. If the trust has $1 million, depending on the size of the trust is the amount, I'll dictate and say, oh, it has $1 million, let's keep a reserve of 30,000. The trust has 100,000, can't say keep a reserve of 30, you might say keep 5. And you'll make a distribution a few months later of the balance, right? All right, why don't we take a break, guys, we'll come back and we'll finish up this segment of the chapter.